Banks make money off of the money that is put into them. That's how institutions like them stay afloat. After all, why would they hold on to everyone's money just to do it? They make money from the interest you accrue and the loans you take out. But in all honesty, banks really don't want you to understand how credit cards work. There are several traps that someone who is trying to get into a good line of credit could fall into, and they could end up ruining the person's credit and in turn their finances. So that's why today we're going over 8 credit card secrets that the bank doesn't want you to know. Make sure you stick around till the end so you know all of the secrets to further understand credit cards and their pitfalls. Number 1. Paying late on one line of credit can affect all your other credit lines. One of the interesting things about credit is that it's all interconnected. Many people don't realize that a credit line tied to one person includes everything from loans to credit cards. The more lines of credit they have, the more a person risks messing up their credit, especially if that person doesn't set up automatic payments. If someone is having to manage several lines of credit and accidentally misses even one payment, it can totally mess up the rest of the lines of credit under their name. This is because the credit companies care more about the name of the person attached to the line of credit than the credit itself. The way they see it, if someone is willing to pay late on one line of credit, then what's stopping them from paying late on any of their other outstanding balances? A good rule of thumb is to make sure to pay all credit balances on time to protect your credit score. Number 2, 0% financing can make a credit card worse. The idea of 0% financing seems pretty tempting to many people. However, this can often become a trap for those who don't know how to properly use it. 0% financing means that the person using this card doesn't have to pay interest on the item that they paid for with the card at the time. It sounds like a sweet deal, but sometimes what the cards don't tell you is that it's not just zero interest, it's deferred interest. This means that if the outstanding balance isn't paid off, they can charge you up to 25% or more in interest. That's insane. If the card company doesn't do deferred interest, then there could be a hidden loophole to get you out of the deal that you don't even know about. The interest benefits could go away after a simple missed payment, late payment, or failure to make the minimum payment. The best rule of thumb if someone is offered 0% financing is to make sure that they understand the rules and regulations of that benefit before going head over heels into debt. Number 3, you actually want to be a deadbeat. As stated in the beginning of this video, a credit card company has the same goals that most other companies do. They need to make money. Credit card companies make the most money from people called revolvers. These are people who constantly have an outstanding balance on their cards and keep paying time and time again for their payments, and in turn, their interest. Interest is how credit card companies stay afloat. They love revolvers, and they hate what they call deadbeats. Deadbeats are people who pay off their monthly payments to their company in full within the grace period so that they don't incur interest. This means that the credit card company doesn't make any money from the deadbeats, and the people who are considered deadbeats end up winning in the end. They end up making their payments on time, continuing to hurt the pockets of credit card companies. The best way to avoid helping the credit card companies make money, and the best way to ensure that they get the best bang for their buck, people trying to save money should ensure that they become a deadbeat. Number 4, you're paying interest on interest. Even something as small as an outstanding balance of $5,000 could still somehow turn into payments of around $20,000 when it comes to interest. Many people find this shocking, and it's nothing to be ashamed of. Interest is a dangerous trap, and the best way to explain it is like this. Compound interest is interest that gradually continues to grow over time. The dictionary explains it as the interest you earn on interest. When investing, compound interest is a good thing. That would mean that the person investing makes more money as their interest increases. However, compound interest on credit just makes someone sink further into debt. It triples the original interest, causing someone to pay triple what they owe. Not many people know this, and it's quite sneaky. The best way to avoid paying more interest at the end of the day is to try to pay the outstanding balance as quickly as possible. By the way, we're on a mission to help people like yourself make billions, so make sure to subscribe if that sounds like you. Number 5, minimum payments aren't what they used to be. When it comes to credit cards, there are 2 different numbers given on their statements. There is the minimum payment option, and there is the full balance that someone owes. The minimum payment is the minimum amount that someone has to pay per month to remain in good standing with the credit card company. If someone doesn't make more than a minimum payment on a larger outstanding balance, they could be in debt for the rest of their lives. Over the past couple years, credit card companies have been making their minimum payments lower. Now, this isn't as good of a deal as someone would originally think. Sure, lower payments seem like the sweeter deal, but it's really not. The lower the payments are, the more interest someone will incur over time. This will end up once again lining the pockets of the credit card company and take more money from their customers. The best way to avoid being tricked by the minimum payments ploy is to make a personal minimum payment that can slowly but surely let someone climb out of debt. Number 6. Credit card rewards aren't as rewarding as they want you to think. Now, the idea of credit card rewards is actually a good thing. Getting cash back, money off, or any kind of awesome discount on something that was going to be purchased anyway just seems like an easy, common-sense deal. Rewards are something that credit card companies give their customers in exchange for using their services. What type of reward a credit card company dispenses can rely entirely on what the credit card company itself offers. It can be anything from direct deposit cashback, aid on loans or mortgages, or even statements that go toward the full balance owed on the card. These can obviously be very useful. However, credit cards usually tend to oversell them. Credit card reward points can be as little as 1 cent per point for a reward, making it take a longer time to get the rewards. The best way to avoid that is to remember that the rewards aren't instant. They're great, but they're not a miracle cure-all to all that ails you financially. Number 7. Understand that your credit card doesn't have a fixed rate. Every credit card comes with what is called an APR, or an annual percent rate of change. This is the annual interest rate that credit card companies can charge someone with an outstanding balance. Credit cards offer a fixed rate sometimes when they are offering their card services to their customers, and in this trick, their customers are thinking that their rates will never change. However, that isn't true. In fact, interest rates can change at any moment if the creditor wants it to. That's just the simple truth. The only time that a credit card company cannot change their APR is 12 months after someone signs on a credit card, and that's only if the APR wasn't a promotional deal. There's barely time to truly stop or prepare, and there's nothing a common customer can truly do. The best thing to do is to make sure that the credit card company that someone has signed on with is a reliable one. They also need to ensure that, just in case, they keep some reserve money off to the side. Number 8. Your credit card company can legally charge whatever interest rate it wants. Though the government federally regulates an awful lot of things, interest rates aren't one of them. In fact, many credit card companies use this as a loophole to charge their customers more when regulations prevented them from doing those things. First Premier Bank drew national attention when it raised its APR to 79.9% in response to the Credit Card Act, which was passed by the government limiting annual fees. The bank set those high APRs to make additional revenue since they couldn't charge annual fees and it couldn't be stopped by the government. Now, sometimes there are state-level regulations, often referred to as usury laws, but no one can truly count on those to cap APR. Now that you know this, it is imperative to compare rates if you want to get a credit card. You need to do intense background checks on your creditor and ensure that their rates are not only the lowest, but that they don't have a history of scamming their customers. Make sure to use trusted sources. And if you found this video useful, then you'll love these. And make sure to subscribe and leave a comment saying, "I subscribed," and we will personally reply to your comment.